Good morning, traders and investors. Roger Scott here, Senior Strategist for Wealth Press. Before we get into all the good stuff, the nitty-gritty, and all the juicy details about what's happening on Wall Street, I want to make sure if you're watching on YouTube, you like our channel, subscribe to our channel, and there's a link to the Telegram link where you could subscribe to get free goodies from me as well. It's all in the YouTube Wealth Press channel. Just go to YouTube and type in Wealth Press and you'll see it. I post my videos there nice and early. And if you are subscribed to the channel, I want to say thank you. Now, it's about 7:38. The market's going to gear up to open about an hour and 52 minutes. And as you can see here, we are very light, treading lighter. The Nasdaq's down about 41 points. The Dow's down about 78 points. Nothing really crazy, but it kind of shows us that the market is not as stable as a lot of investors believe it is right now. And folks, earnings are on the way. We got 3M, we got Google, we got ADM, we got Biogen, we got Centene. We just got out of the stock because we were short, so we didn't want to hold it through earnings. We got Chubb, we got Cornings, we got Dow, Enphase. I mean, you name it, we got it. General Electric is reporting today. Halliburton is reporting today. Juniper Networks is reporting today, another stock that we actually are holding right now. McDonald's, I mean, you name it, it's reporting today. This is a major, major week. Sherwin-Williams, Pepsi, Bancorp, UPS, Visa, all of it is reporting today. And then the big one, Microsoft. They're expecting to be up 3.4% year over year on their revenue, and they're expected to be at $2.23 EPS. Now, let's just quickly take a look. Let's just quickly see what Microsoft is doing right now, so we can get an idea. I don't know if it's coming out before the open or not, but as you can see here, they were down at 0.40, not at 0.40, 1.4%. And right now, they're down already 1 point at 0.36%. So Microsoft could be getting a little softer. And remember, look at that. They're moving this way. Now, I hate to say I told you so, but there's two things that I did tell you about. Now, I've been saying this for over a month. Look at the cumulative. Technology, communication services, right? Discretionary is now all the way here, but look at it monthly. Look where the three of them are. And by the way, they're together. Now, how long have I been telling you guys that these three need to cool off and they need to be together? And finally, for the first time in about a month, or no, first time in about 2 months, communication, technology, and consumer discretionary are together. Not on a cumulative basis, but already on a 1 month basis. You could see over the last 30 days, they've actually produced the least amount of gains of any of the sectors. And you don't need to be a whiz to figure that out. I showed you momentum levels over a month and a half ago. So let's just kind of quickly go through them and you could see what I'm talking about. Remember I told you this was going to cool off? Right here, it was going to come down. From here to here, it's coming down, and I think it's going to come down more. That's the discretionary sector. What about technology? Look at the technology sector. It's actually kind of really coming down. Look at where it is right now. Remember, it was up here only about 3 weeks ago? I told you so. I remember the video. I remember even telling you that it's the highest level since COVID recovery, and it's come down quite a bit. That's the technology sector. How about the communication sector? I told you those three were coming down, and look at where it is right now. It was up here 22 days ago, and I told you that when it comes up here, it cools off, and it has. There's one more thing I told you about. Remember I said those pesky last Friday? I told you that the funds like to hit the stops right here, right before they turn around, and they did exactly that. Look at that. They did exactly that right here. They did exactly that right here, the algos. So the fact is, because earnings are not as good as they are, interest rate sentiment is moving lower. Bonds higher means interest rates lower. I'm expecting that's the cause of lower than expected earnings and a potential shift in the Fed. But so far, the Fed fund rate is still expected to move up on May 3rd, 0.25 basis points. So I think we're just going to stay in this channel like we've been for a while. And if we do get back up here, to the 108, 109 level, I'm going to, maybe even the 110, I'm going to sell this bond again. I'd love to sell it to the downside here, but too much risk because the trend is still lower. And we want to go with the trend, not against the trend. Now, let's talk a little bit about what we're expecting today. But I'm going to tell you right now, communication services, technology, and consumer discretionary are in fact the three weakest sector, and they are finally together on a month-over-month basis for the first time. Now, that should spill over across monthly, and we should see this across all three periods, but this is a good start. And in terms of strength right now, energy, utilities, consumer staples, healthcare, basic materials, financial, real estate, and industrial, this really looks like how it should, or more or less stable in terms of how it looked. Now look at it over several months. Technology, communication services, consumer discretionary, real estate is still down here. No. Things are not looking like that. This is really a better picture of how things are looking. And I know I'm jumping the ship because I'm looking at the last 30 days, but I'm telling you right now, it's going to fill in the blanks, and most of what we can expect should look similar to this. Like, for example, industrial is close to, where is industrial? Basic materials, they're not that far apart from each other. Consumer staples is next to healthcare. Both are defensive. Utilities are defensive. Energy and utilities are next to each other. This looks like a much more realistic market than what we're seeing over the average. So right now, I would definitely go with the 1 month ranking because it's actually being very accurate. Now let's talk a little bit about Wall Street, what we can expect, and then I'll get into the strongest and the weakest stock and the strongest and weakest sector. Why? Because it's Tuesday. That's what I do. All right. Three major U.S. benchmark indices ended the regular session mixed as investors braced for quarterly earnings from some of the biggest techs like Microsoft. Benchmark S&P 500 and the Dow closed slightly higher, but the Nasdaq underperformed, weighted down by Chinese tech companies and more than 1% fall in shares of Tesla after the automaker raised its capital expenditure forecast to 7 to 9 billion from 6 to 8 billion. That's quite a lot of billions. That's like a nice 15-20% jump. First quarter earnings are on the way. Microsoft, Alphabet, Visa, Pepsi, McDonald's. Be really careful right now trading this market. Analysts expect aggregate earnings to notch 4.7%. Right now, we're compared to 5.1. Don't hold your breath. It went from 4.8 to 4.7. It's looking a little better, but not much. And I think the worst is going to start coming our way. Meanwhile, the interest rate scenario hasn't changed. We're still locking in a 0.85% of a 0.25 rate hike on May 3rd. And as I said, the bond market is actually rallying right now on this because I guess earnings are not coming out as well and the economy is not as strong as it appears to be. So bonds are giving us a little break. Remember, this is the long-term bond. If you look at the shorter-term bond, which we'll look at right now, let's see if it's been moving as well. Yeah, notice it hasn't been moving higher. So short-term interest rates are expected to go higher, but longer, like the 10 years are backing away right now because the economy is softening up. But again, the 2 years, what you want to focus on right now in terms of the main trend, and the main trend is lower bonds, higher rates. So right now, bonds are actually moving higher in terms of the short-term view, the two-year bond, which is not a good sign at all. Now, today we've got consumer confidence, new home sales. I'll talk about that in a second as well. Actually, right now. Today, all eyes are focused on consumer confidence. Also new home sales, also building permits. Watch that carefully. That's in play right now. If the housing market slows down, that may be a cause for the Fed to slow down its rate hikes. And by the way, I don't think the Fed is anywhere near done, especially with the data that we're seeing. We're also going to get the Richmond Manufacturing Index, but the biggest thing is going to be the consumer confidence and new home sales. Europe stocks are down 0.53 as investors assess more corporate news. They're really looking at what's going on in this country to digest what's happening with earnings so they can adjust their economy. Comments from central bank policymaker while cautiously awaiting the start of big tech earnings season on Wall Street. Now, there was, some losses in mining and bank stocks that are leading the overall market lower. But honestly, Europe is keying off of U.S. right now. China closed lower for the fifth straight session as investor sentiment remained weak after data released Tuesday pointed to an uneven recovery. Honestly, I don't know how they'll have an even recovery with a 3-year COVID cycle that we haven't had here. So to me, that's just mind-blowing. Nikkei closed slightly higher for a second straight session lifted by electronic makers on earnings optimism and expanded government subsidiaries for chip products. That's really good. Chip stocks gained ground after industry minister That's the new guy that took over. And this guy knows what he's talking about. He's going to raise rates, and it's going to cause the yen and commodities to go up. He's not as concerned with import-export. He wants the economy to grow internally. Said the country intends to give additional subsidies to chip makers. This guy's smart. I like this guy. He's an MIT grad. He was trained. He was trained in the U.S. He's supposed to do a lot different than the last prime minister, and I'm expecting that. Pre-market, First Republic Bank is down 21%. Not very good for bank stocks. This may reflect on other financial stocks today. Cadence, one of my top gaining stocks, is down 4% because of earnings, and Packaging Company of America is down more than 5% after bad earnings. That's why trading during earnings on the specific stocks could be dangerous. Just ask me with my PRG trade that I mistakenly put on VIP room ahead of earnings. It was my mistake, mea culpa. What am I going to do? But yeah, we're down because of that right now. Not good. Bad Roger. Bad Roger. So today, Microsoft, Google, Visa, Pepsi, McDonald's, Danaher, United Parcel, Nextera Energy, Texas Instrument, Verizon, Raytheon Technology, great stock, General Electric, Chubb, and I can go on and on, UBS, Sherwood-Williams, 3M. Keep an eye on UBS. That's a good second-tier bank stock. Moody's, Chipotle, Kimberly-Clark, General Motors. I mean, throw a dart and you have a big cap stock. This is one of the biggest. This week and next week are going to be really, really big. Now, let's talk about strongest sector, strongest stock, weakest sector, weakest stock. Now, right now, I really like energies, and I like utilities, and I like consumer staples. Healthcare doesn't look bad either. I would not be going long. Industrials looking good. Financials looking good. The sectors that I would stay away from right now, especially right now, would be consumer discretionary, technology, and communication services. And the sectors that I'm liking are more blue chips, like energy, like utilities, like consumer staples, like healthcare. These are looking really good right now. All of them are actually looking really good right now. Now, in terms of the best stock and the worst stock, oh boy, let's talk about this. Not going to be that hard. So let me tell you what I really like right now, a lot. I like Lamb Weston, all right. I like Las Vegas Sands, but you got to be careful with Las Vegas Sands. Honestly, GE looks amazing right now, but it's got earnings today. But I do like Lamb Weston, and I really, really like Pulte Homes. Look at these stocks: Lamb Weston, and Pulte. They look great right now, really good. GE looks good too, and so does Wynn. But we got earnings on GE, and we've got some earnings this week on Las Vegas Sands or other Vegas stocks. And also, they are consumer discretionary, so I would be careful with that, and I would stick around more with Lamb Weston or with Pulte Group. And also keep your eye on GE. I know it has earnings today, but man, oh man, that stock has been just rocking and rolling. Those stocks look really, really good, like really, really good. Now, in terms of the crap that's out there, oh boy, don't hold me back now. GNRC, oh, GNRC, my friend, you're about to go down for another slide. GNRC is looking bad. Xeon Bancorp is looking awful. Match, as I told you guys about 2 weeks ago before it went down more, looks awful. And VFC looks awful. So you've got plenty to work with. You got Generac. You've got Lincoln National. You've got Boston Properties. You've got Xeon Bank, KeyCorp. I mean, just take a pick. Fidelity National Systems. I think I'm going to short this stock. And so these stocks just look awful. Comerica looks bad. Match looks bad. But if I was to pick the biggest stinkers, I would say Generac, VFC, and Match.com. And Xeon Bank. There's several. There's just, I don't know which ones to pick. There's so many stinkers out there. But that'll give you something to deal with right now. Now, before I let you go, folks, there have been a lot of ups and downs in the stock market lately. And if you're like most traders, you're tired of it. You're sick and tired of it. Well, my friend and fellow trader, Jack Carter, and Jack Carter, he's been around this block many times. He's very excited to share what could be a big game changer during a very difficult market conditions like we're seeing right now. It's hidden stock calendar that he's recently discovered, and he's preparing to go live at 2 p.m. Eastern to reveal the calendar and 10, not one, not two, but 10 potential trades that it's highlighting right now. Click the link below. Check it out. This is brand new. Jack Carter, he's been hot. I've been talking to you about using his stuff since last summer, and I told you that implied volatility and options were going to be high and we're going to be choppy, and Again, I was right. I hate to be right sometimes because sometimes that causes investors to lose money, but I'd rather tell you the truth. And Jack Carter is hot. You got to check out this calendar that he recently discovered. It's very, very cool. It's brand new, and it can help you be a game changer or create a game-changing environment during the current market environment. He's going live at 2 p.m. Eastern time. I'll throw a link in my VIP room today at noon just to refresh your memory, and you don't want to miss out. It's free, doesn't cost anything, and you don't want to miss a Wall Street pro like Jack Carter, especially when he's got something new and it's based on seasonality. And you guys know how much I love seasonality. You guys have a great day. Remember, subscribe to our YouTube Wealth Press channel. That's where I upload these videos every morning. There's a link below this video to that channel, and you can subscribe to Telegram, where I post pictures of myself, my wife, my cats, give you free trades. There's a lot of goodies in that Telegram channel, and you'll get an update on these videos immediately because I post a link right after I upload them. You guys have a great Tuesday, and remember, it's going to be a crazy, crazy day for the market. It may not be the worst idea to stay loose or lower your exposure. Bye, guys. Have a great day, and I'll see you on the other side. Bye.